Hello everyone. So today our group will present about the studies of the credit risk in the banking sectors involving Indonesia. In this study, we have include the five major banks that been used for the data to find the determinants for the credit risk in the banking sectors of Indonesia. As we know, the first one is BTPN, Bank Tabung Pensiunan Nasionals, had a headquarters in Jakarta, which is established as the foreign exchange commercial bank with subsidiaries of BTPN Bank Syariah. So the main focus of this bank is to serve the pensions, micro, small and medium enterprise and also poor community. For the next one is Bank Rakyat Indonesia. It's similar to others banking service and it give more focus on micro, small and medium enterprise. It's currently 70% government owned operating company under Persero, and during the November of 2003, 30% of its share was sold through an IPO. So the next one is a Bank Central Asia. BCA delivered the best financial service in Indonesia. It's a strategic of a bank to focus on credit quality, growth, and efficiency. Bank Negara Indonesia is the oldest commercial bank in history, Republic of Indonesia, and currently has 9 subsidiaries. Bank Negara Indonesia is a bank owned by the government, so it's safe because it's guaranteed by the government. So the last one is Bank Mandiri, is Indonesia's largest bank by assets, loans and deposit. Mandiri Treasuries competes with rivals that have highest quality service and sufficient infrastructures, information systems in order to fulfill the vision of the best treasury house in the religion. So we focus on the next is the problem statement. Throughout the studies, the significant increase of the loan to a riskier borrower resulting in a higher bank charge-off. So due to extensive lending functions, banks are more likely to take on greater risks. The bank must recognize the root because of major credit issues and incorporates a sound risk control strategy in order to optimize the profits while minimizing the risk.
Literature review. The first is credit risk. Credit risk can be defined as the risk that caused by reduce of the market value due to the change in the credit quality of issuer. Leverage. Leverage can be defined as the capability of the financial institution to income their profit or losses through direct investment of their own fund. Risky sector finance. Risk faced by the bank could be from credit risk, market risk, operational risk, and few other risks involved. Regulatory capital. The regulatory capital will resulting from the increase of a social welfare function, such as the rise in the cost of credit. Loan loss provision. The loan loss provision is the credit risk management tools that the bank use to moderate expected loss on bank loan portfolio. Finance of bank. Financing is the process of providing fund for business operation or asset. The next is equity multiplier. Equity multiplier is a risk metric that determines how many of a company's investment are backed by equity rather than debt. Liquidity risk. The risk of not being able to liquidate at a fair price in timely manner is known as liquidity risk. Risk-weighted asset. Banks and other financial institutions must hold risk-weighted asset to assess the minimum amount of capital they must hold to minimize the risk of insolvency. The next is management efficiency. The use of appropriate bank management strategies is primarily responsible for successful enhancement of the profitability risk ratio in a bank's lending operation. The next is firm size. The net market value of a fund's share in asset size, total assets, which are influenced by supply, demand, and market return, are reported on daily basis of funds. The last is money supply. M3 is a numerical composite that includes M2, large time deposit, retail money, market accounts, short-term purchase agreements, and other financial reserve.
Hi, Assalamualaikum. My name is Atiqah Basyirah Binti Suhaidi. I will be presenting about the data analysis. So we will show the movement of BTPN Bank, Bank Rakyat Indonesia, Bank Central Asia, Bank Negara Indonesia, and Mandiri Bank ratios is analyzed from 2016 to 2020. There is a conceptual structure in this analysis that is used to explain the association or correlation between the variable dependent and the other variable dependent. From here, we can see that the firm-specific factors, macroeconomic factors, and the combination of firm-specific factors and macroeconomic factors is correlated to organization extends the loan limit to another party, which is the credit risk. This is the table measurement variables. In this study, the data were determined to generate the end results using IBM SPSS version 25. This software is famous for data mining, analysis of the market, and for advertisement. The IBM SPSS statistics software is able to carry out the descriptive statistics, bivariate statistics, count prediction, and even prediction for the group recognition. However, in this IBM SPSS metric is only used to measure the linear regression and correlation analysis between the quantitative data variables. Quantitative data are numeric vector data, and data were collected in these studies in 2016 to 2020 annual report of BTPN Bank, Bank Rakyat Indonesia, Bank Central Asia, Bank Negara Indonesia, and Mandiri Bank. That's all for me, so I will pass to the next presenter.
Hi, my name is Haifaa Binti Zuki and my metric number is 264765. So now we are moving to the model summary. The value of adjusted R squared is 0.963. This value is close to 1. The value of adjusted R squared close to 1 means that the linear regression is somehow fit in the model. So now for the W-Watson. The value of W-Watson is 2.695. The value of W-Watson shows that the sample does not detect an autocorrelation, as the value of the W-Watson between 2 to 4 shows the negative autocorrelation. And next one is ANOVA table. The significant value is less than 0.05, so this significant level shows that the regression does have the consistent variable. And the next one is the descriptive statistic. The descriptive statistic is used to describe the fundamental features in the data of the analysis. And from the table, the M3 has the largest value of mean, and also the M3 has the largest value of the standard deviation. And in other hand, the ROA has the lowest value of mean, and also ROA has the lowest value of the standard deviation.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Yusri and my metric number is 265663. So today I will talk about correlation and coefficient table. So we'll take a look for our table. We need to look at the significant level. So the independent variable which are positive for the capital receipt are LEV, RSEC, regap, finance, RWA, DER, DITAR, MGT, and LN size in the table that we show right now in the screen. So this company specific variable are associated with the existing dependent variable. From the table, only DER have the p value that less than 0.05. This implies that there are significant correlation between DER and CR. We conclude that there is a linear relationship between DER and CR at 0.05 level. That means when DER increase, CR is tend to increase too. However, in the sense of large level, such as internal independent variable, the LEV, RSEC, regap, finance, RWA, DITAR, MGT, and LN size have a high level of p-value greater than 0.05. This indicates that the stated variables are poorly linked to this relationship. This result in a low credit impact on a credit risk, which implies the capital receipt is not important for the stated variable. In the table shown above, the independent variable that negative correlated to capital receipt are liquid, EM, FLP, and ROA. Next, we go to macroeconomic factor. So, for this table, show that the independent variable that positive correlated to the capital receipt are infla, M3, and OGAP. This macroeconomic factor is positively correlated with the dependent variable, which is capital received. And also in this table, the independent variable that negative correlated to capital received are GDP, IR, YC, and UR. It means that this macroeconomic factor are negatively correlated with the dependent variable, which is capital received. Next, we also will look on the firm-specific factor and macroeconomic factor. So, the independent variable when combining firm-specific factor that we can achieve from this table is that are positive is MGT, DITAR, DER, RWA, Finance, RIGAP, RSAT, LEV, OGAP, M3, Infla, and LN size. So, these variables are associated with the existing dependent variable. So, in this table also, we also can see that there is a negative correlated with capital receipt, which is GDP, IR, YC, UR, FLP, EM, liquid, and ROA. So we can say that these factors are negatively correlated with dependent variable, which is our capital receipt. Next, we'll go to coefficient. So first, we'll go to firm specific factor. So as what we can see in this table, the study show that the CR is not positively significant influence with all of the independent variable. It is because the p-value for all of the independent variable is higher than 0.05. That's what we can see in the table. This show that the increase in credit risk will not influence with the appreciation of all of the independent variable. Next, we'll go to macroeconomic factor. Okay, so based on this table, as what we can see in this table, this study showed that the CR is not positively significant influence with all of the independent variable, which is macroeconomic factor. So this show that the increase in CR will not influence with the GDP, GDP which is macroeconomic factor, infla, OGAP, interest rate, and employment rate. Last but not least, we go to firm specific factor and macroeconomic factor. So based on this coefficient table, this study showed that the CR is positively significant influence with only one of the independent variable, which is RSAT. So you can see here RSAT. Because RSAT is below than 0.05, which is 0.026. That's all from me. Thank you so much.
What's our finding? We can conclude that there is a negative relation between the credit risk and our internal factors. Besides that, factors that negatively influence our credit risk also the external factors. We can say that internal and external factors will negatively influence the movement of the credit risk. Further study is need to be done to ensure that we could gain more in the future research. We can recommend to look to another internal and external factors when we want to make a further study towards this topic. The other external factors that can be looked up on, such as the impact of the COVID-19 to the particular sector have to face, and many more. That's all from us. Thank you for listening.